Hi everybody, it's Thursday and we're on the floor of the New York Stock Exchange with Jim Cramer. All right, Jim, we are trying to work our way back from yesterday's declines.
Yeah, we got to be careful. I want the financials up, and the financials are, it's really important for that leadership group. We can't just do it with tech. Retail's a little bit softer on a couple disappointments. So new course not up nearly as much as it should be. So I just want to be mindful. It's a long day. And we got to get the banks to turn around. And it's got to be led by JPMorgan, because JPMorgan stands to make a lot of money, or Wells Fargo. They stand to make a lot of money in the Comcast Disney battle for the Fox assets. So let's watch that group. If that group goes positive, we're going to have a fine day. If it doesn't, it could be a long day.
Although I'm seeing reports about potentially new tariffs tomorrow. It seems like investors...
that's going to be an issue. Retail sales, the aggregate number, really terrific. Jobless claims, really sensational. We shouldn't have been down as much as we were yesterday, and it was just a heartbeat. That was a sell program. At the end of the day, and the reason I say that is because the comeback from, let's say, 245 to 315 was really based on the fact that Powell was so measured and saying, listen, we might have to do another rate hike, but we'll stay tuned. And then the market acted as if, there was, that things were going to be imprudent, and JPMorgan, which was up a lot. I'm following JPMorgan because JPMorgan, I think, should be doing, the stock needs to be doing better, because you can't just be led by Fang and company. And I want to see the financials, or I want to see the health cares, or I want to see the industrials. You need to see this pastiche of two or three of them going up. I see the industrials doing a little better today. Nice note on Caterpillar. But I just am mindful that a JPMorgan rally takes us to all-time highs. A Fang rally takes us to where we are.
Okay, that's an important note. Meanwhile, Jim, RBC saying that Walmart is gaining traction against Amazon. What did you think?
What'd you think of that?
Well, I will tell you a story. I bought a bunch of stuff on Amazon recently. Before I clicked, yes, I'm going to buy it, I decided to put the same things on Walmart.com. I found they were 30% cheaper.
Okay, see, that's what I ask you, because that's what people are seeing. They're seeing Walmart being much more competitive. And that's not what we own Amazon. It's our biggest position, fraction alerts. We own it for Amazon Web Services. We own it for Amazon Advertising. We own it for Amazon getting the Premier League. But we don't want to see Amazon be undercut dramatically on price. And yet there I was interviewing Jeff Gannett this week on Macy's. They're talking about being competitive. Best Buy being competitive. Now we got Walmart being competitive. So does Amazon have to cut price again? We have to see what they do with Whole Foods. But my takeaway is that Mark Mahaney's piece, it gave me pause. Now, we're not going to get rid of Amazon. Davidson said just to upgrade it to 2,100. But Amazon, you don't want to see Amazon. We're seeing the same thing you are, Scott. Amazon, periodically, you got to do price check against Amazon. I haven't ever had to do price check against Amazon. So I think that's some of what Mark's going at. I await what Mark says on Squawk Alley. He's a straight shooter. I've known him for years, but that was the first blemish that I've seen in Amazon since, I don't regard the post office as a blemish. First blemish in Amazon I've seen in ages, so I'm mindful. I do like this story, though, but it's just good to keep track.
And we'll talk more about Amazon in our Action Alerts Plus video after this. Meanwhile, Jim, last night, speaking of retail, you had the CEO of Restoration Hardware. The stock still on fire.
Yeah, look, what's a recipe for a stock to go up a lot here? One, you need a robust consumer that impacts that. We certainly have that with RH, particularly the upper, which is a beneficiary, by the way. The states that it's doing well are some of these states where you got a big tax cut. New York's fine, but Texas, Florida, and the disposable income went up. You need a big short position. Well, Restoration Hardware is a gigantic short position. You need sharply better than expected earnings per share. That's what RH had. And next thing you know, you've got a revaluation where you start saying, well, wait a sec, maybe we got to do market cap analysis. Maybe $3.5 billion is not large enough for the opportunity. Now, typically when I do that kind of analysis, people get angry at me, but so they say that that's just justifying a move. But I felt that way about Salesforce. I felt that way about Amazon. I certainly felt that way about Netflix. When Netflix was at $25 billion, I said, this is ridiculous. The opportunity is so far greater than where the stock is. Well, that's how I feel about RH. The opportunity is much greater than where the stock is.
And from what Gary told you, it sounds like he's redefining the retail experience.
Yeah, he's not a retailer. He's opening a hotel. He's got restaurants. He was talking about the restaurant being primary. What he is a gallery, and it's a staging ground, so that when we buy stuff from RH, we know what it looks like. It's kind of similar, by the way. On Mad Money we had Hal's on last week, HOUZZ, and what anything that allows you to imagine better. Like RH, it's easy to imagine because of their stores, which aren't even stores. They're showcases, and the showcases for great, longer-lasting, investable product. And I can't say enough good about RH. I just think that Gary, who telegraphed everything, he bought a ton of stock in the 20s. He told you. He bought a ton of stock for the company bought a ton of stock. It was all available. Every bit of it was available, and he made that point last night on Mad Money. It was all available. What were you thinking, people? And the answer is there were a lot of shorts who just said, this one's going to blow up. And it didn't blow up. It did have a period where it did blow up, and Gary talked about that. It blew up and went from 105 down to the 20s because they missed. But he shifted his model during that period to a membership model. Remember, we like Spotify membership, we like Costco membership, we like the subscription economy. It's really, really important. And he also decided to go for earnings, not revs. And it all came together. I just think that he's remarkable. And he's been underrated the whole way. It's interesting you mentioned Barry Sternlick on his board, who suggested some of the things that are going on. Barry, man, I revere, always one step ahead of everybody else.
Yeah, the no coupon bond, which is pretty interesting.
Yeah, it was really good.
Jim, you mentioned Salesforce and Netflix earlier. Those are part of...
Look, these are Cloud King. Salesforce is Cloud King. Salesforce and Netflix, $100 billion club stocks. Are these overheated? We are in a romp, and this reminds me of not 1999, okay, but in the 90s, we had summer rallies. I mean, literally, we had summer rallies. Like, you'd be like, and all the papers would be filled with it. This was, of course, all pre-crash, 2007, 2008. And it'd be like, wow, the summer rally is early. That would have been normally what the lead of the papers would be. And because, remember, summer starts next week. But no one talks about summer rally anymore because people are always too muted. But what's going on here is animal spirits, a belief that inflation still is low enough. I mean, the PPI number was high, but inflation's still low enough, economy's still strong enough. Draghi's saying some good things about how the economy getting better there. People didn't interpret as good. I did. And then you got the Comcast versus Disney, where both stocks, Comcast and Disney, are going up because people are saying, wait a minute, their stocks have been depressed. So you've got a kind of a confluence of things that is just waiting for one piece of tinder, and that's the backs.
Jim, who do you have coming up on Mad Money tonight?
Well, I've got Shantanu Narayan, Adobe, what a stock. I've got Thor, recreational vehicles. I've got to see how that's really doing. And then Zora, which is the subscription economy, which is really a lot of what's behind this whole big, Adobe being subscription. It's funny that they were like the first to want to go subscription after Salesforce. Really fabulous, fabulous relationship we personally at the street have with Zora because Margaret DeLuna, who's president of the consumer business, was their keynote last week at their conference. And the subscription economy and the street are one and the same.
All right, Jim, I want to remind everyone that you had your Action Alerts Plus call yesterday.
Yeah.
You can join the club and watch the replay.
I thought it was good. I mean, we spent 55 minutes. I was sore. I was hoarse by the end of it. But Jeff Marks and I kicked around Salesforce. Someone on Twitter said, Jim, that wasn't very convincing. And I wanted to say, okay, listen, you chowderhead. What do you need to do? It's because really. I mean, we have just... Our Salesforce, the recommendation has been so elaborate that we just wanted to show people what we do behind the scenes. I was just trying to recreate what it's like in the morning when we come in and we talk about buying. And so I urge people to go to the videotape. Because again, I ask you, when you watch it, I want you to know I want to ask you two things. One, does your mutual fund give you a tape like that so that you see why they bought Salesforce? And two, does your mutual fund tell you what price you bought stocks? Because I think that the experience of Action Alert is a teaching experience, not a hiding experience. The hiding experience is not for us.
Well said, Jim.
Thank you.
Thank you so much.